Welcome traders, Maciej here from Taurus Trading. Today you will learn about risk management and make sure to watch the whole video, since at the very end I will show you the most important chart and a table that you will probably see in your entire trading career, so stay tuned. Risk management is the most important skill for successful traders. The saying is true: there are old traders and there are bold traders, but there are no old bold traders. Risk management is the specific actions you take to protect your trading account from losses. The less money you lose in your first few years, the longer you stay in the game, and that means more time to work at finding consistency. If you take care of your downside, your upside can take care of itself. There are three basic risk management rules. First one is identifying risk, second, determining risk to reward ratio, and the third, proper position sizing. So first, let's talk about being aware of the risks in financial markets when trading. Risk planning will help you better control the mental part of trading, because you already know in advance more or less how much you are going to make if the trade goes in your favor, or how much you are going to lose if the trade goes against you. The second very important thing when it comes to risk management is trading risk to reward ratio, potential loss versus the potential profit on any given trade. You need to have a strategy with higher trading risk-reward ratio, as this will ensure profitability in the long term. And the third rule of proper risk management is position sizing, and this one is actually very often not appreciated enough by beginners. And this is basically how much of your account you want to risk percentage-wise. When you start day trading, stick to small risk like 1% or less of your account, and I personally like to risk not more than 0.5% of my total account, because this helps me to sleep well at night. As you probably have already noticed, in your trading career there are a lot of trading strategies, but let's focus on the most effective ones and pros and cons of these most profitable trading strategies. So let's talk about pros. First one is greater returns in a given time period. Like I said in the beginning, I will later show you the most important table that you probably haven't seen in your trading career yet. And this will explain what I mean by greater returns in a given time period comparing to these less profitable trading strategies. Second most important thing is positively skewed distribution of returns, and that means that your average winner is way more bigger than the average loser. That if you're planning to do your trading for a long period of time, you basically are guaranteed a success. And now let's talk about cons. And the first one is longer losing streaks. And personally, I can tell you from my experience that I've already had a losing streak of 60 trades, which were all losers. And this is not something particularly pleasant, but trading has never been made for having a good time. Most of the time you will be losing. Second con of the most profitable strategies are bigger drawdowns and high volatility. So keep in your mind that most of the very profitable strategies will have bigger drawdowns and high volatility. And of course, most of the time you can pretty much set this if you are automating your trading. However, be prepared to have drawdowns of 20 or 30% or more, and same with the volatility of your portfolio. So now let's get to the meat and potatoes of this video. Like I said at the beginning, this is going to be something you probably haven't seen before, These two tables are showing how much you can expect to earn if you're having a fixed profit target. 2R, for example, means that if you have risked, let's say, 100 pips on your trade, that means that you're planning to take profit not less than 200 pips, and so on. And on the bottom row, you can see results for a trailing stop. So after 2R, that means that you're trailing, in this example, 200 pips, a trailing stop, and you're basically letting market to tell you when you will exit your trade. And as you can see, the number of trades is pretty much the same. It's around 3000 of trades taken. The results, it's gain in percent. You can expect to have much more gain if you're trailing your stop, and basically the bigger buffer you give to the market, you're trailing 5 times. So in this example of if you have risked initially 100 pips, you will be trading 500 pips, and I can guarantee you that most of the so-called internet gurus will go mental if they will see 500 pips trailing stop. That's how money is being made in financial markets. So the second chart or table I would like to show you today in this video is from Valery's Zakamulin scientific paper that he have published a few years ago. And from this table you can tell that he basically backtested the optimal length of the moving average. This is based on the daily chart. However, you probably have heard that markets are fractal, so you can apply this to any given time frame, even very small time frame like 5-minute or 15-minute chart. So as you can see, for last 120 years there is no optimal length of moving average, and actually it's constantly changing. So you shouldn't be surprised that if your trading system is based on any indicator which is calculating the price of the instrument that you're trading, you're not going to get stable, good results. That's it for today's video. I hope you've enjoyed, and I'm looking forward for any questions in the comment section. And make sure to visit my website and grab the free ebook about financial markets that I've prepared for you. I will see you in the next video. Take care.